Good morning, everybody. This is Greg Gossett from Gossett Trading and Mentoring. How are you? Hope you're doing well. Hope you had a good trading week, and I really appreciate you coming and spending some time with me on the weekend here with my weekend review. So, interesting week last week in the markets. Markets continue to move higher. The indexes, but individual stocks have been, they're kind of doing their own thing. So, anyway, I hope today is going to be helpful. The format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have and all the trades that I made last week, both open trades and I also closed some trades as well. So we'll talk about when I entered the trade, why I entered the trade, what my thinking was, what the signals were, what the confluences of signals were of why I entered the trade. Then we're going to talk about how I position size. We're going to talk about where I place my two stops, my emergency stop, and my end of day stop. We're going to talk about taking partial profits as the market went my way, and then basically how to manage the trade. So, trading is not just about hitting that buy button. There's a lot more than that, right? You have to position size based upon the volatility of the market. You have to place your stops. For me anyway, I take partial profits into strength, and then there's significant overhead resistance levels and different price actions that tell me what to do. In my trading, it's pretty systematic depending on the strategy that I use. If the price does this, then I'm going to do that. If the price does that, then I'm going to do this. I think it's a lot more relaxed way to trade, and I think it's the more correct way to trade. I just think it's a better way to trade than just being completely discretionary and making an entry or an exit based upon a win. So we'll talk about all the trades that I have, how I'm managing the trades. I did get out of some of the trades, and I'll explain to you why. After that, we're going to talk a little bit about trader psychology, always the most important skill in trading. Everyone in trading seems to talk about, oh, there's this strategy and there's that strategy. And hey, there's a lot of strategies that work. There's a lot of strategies that work, but they only work if you follow them through. And sometimes, you can have the best strategy in the world, but it doesn't work maybe for three trades in a row, and you think, oh, this strategy isn't any good. Well, you have to look at things in the long term. You really do. It's like a casino. I mean, if they deal you a couple hands of blackjack and they lose and you win, they don't say, well, I guess we're getting rid of blackjack, right? I mean, they know over the long run they're going to win with blackjack or roulette or craps or whatever, but they certainly know that their customers are going to have winning streaks as well. But you don't want to get rid of a good trading strategy just because it doesn't work the first couple times. So, but the whole point is that so many good trading strategies out there, but they're not good if you don't follow them. You have to follow them. That's the important part, and that's where trading psychology comes in. Following your process. Do you know that 90% of traders lose money because they don't follow their process? Yeah. So I think we better follow our process, and that comes down to trading psychology of having faith in your approach and following it through. So it's always helpful for me to teach trading psychology, and I hope it's going to be helpful for you, and that's why I included in the podcast. After that, I have gone down through my master watch list. I did it last night, and I have identified some potential trades for next week. Now, these trades are not where they need to be yet. But that's what I like to do on Friday nights. I like to go through the list, both on the daily time frames and the weekly time frames. And, I look at a chart and say, okay, if it goes down to here, then we'll have a 200-day moving average. We'll have a 30 RSI. We'll maybe have a double bottom bullish divergence. It's important to just be patient, look at a chart, and say, okay, if it gets there, that's the place. And then mark that in your notes, look at it every day, whatever. And then if it does get there, then you can potentially take the trade. It improves my trading dramatically by being very patient, looking at a chart, going, this would make sense if it gets there. And if it gets there, great. potentially take the trade. If it doesn't get there, fine, just move on to another market. So that's what I've done, and I hope this is going to be helpful for you. I've done it both on the daily time frame and the weekly time frame, and I have identified some potential trades next week that if they get there, it would make sense because there would be a confluence or combination of signals and indicators at that level. And if not, then I just won't take the trade. So anyway, that's going to be the format for today. And let's get started. Let me get this U.S. legal disclaimer out of the way, and then we'll get rolling. Hang tight for about 40 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, so I trade about 7 different trading strategies. Each one has their different rules, and so the potential trade or the current trades that I have now will be a variety of different strategies, and I'll explain them as we go. So, okay, here, first of all, to get started is Pfizer. I did get long Pfizer back on the 12th of September at 28.85, and let me explain why. So, you see this green box in here. This is what is called a fair value gap. And a fair value gap happens when you have a low, followed by and then a little rally, and then followed by a low. And then you have a big move up that takes out the previous swing high. This changes things from a downtrend into an uptrend. And when you change from a downtrend into an uptrend, generally it's a good idea to buy the first dip. Okay, and the dip in this green boxed area here consists of 3 bars. There's bar 1, bar 2. Bar 2 is the bar that took out the swing high, and then bar 3. And you see here on the 9th how we had this big, huge move up. This is the bar that took us into the uptrend. There's a gap between the high of bar 1 and the low of bar 3. That's where this green box is. So this is an area that it just went straight up and the market never tested. So when it comes back into this green box, this is what I am looking for. So here on the 12th, when I entered the trade, it came deep down into the bottom of the green box. It went below the green box for a little bit and then moved up. That was my signal to get into the trade. So I got in at 28.85. So that's the signal on a fair value gap. So let's talk about position sizing, because position sizing really, when it comes down to it, I think it's the most important part of trading. All in all, I think it's the most important part of trading. So the formula that I use is based upon the account size that is being used. So let's just say today it's a $50,000 trading account. So I take 1%, so I take 50,000, and I times it by 1%, which of course is going to be $500. Okay, so now I take that $500 and I divide it by the value of the 2 ATR. ATR means average true range, and this value is 2 times that. So divided by $1.22, this would tell me to buy 409.83. I just round that up to 410 shares. So now, of course, if it was a $100,000 trading account, I would be 1% is 1,000 divided by 122, and then obviously would just be double that. And so as soon as I enter the trade, now I've position sized correctly. Now I've bought the appropriate amount of shares based upon the current volatility of the market and the value of my trading account. So when I enter here at 28.85, the first thing I do is that I place my emergency stop, and the emergency stop is the value of the 2 ATR, exactly $1.22 below my entry. So therefore, if I have 410 shares and it gets all the way down here to my emergency stop, how much did I lose? I lost $500 if I'm using a $50,000 trading account. Okay, that's 1% of your total account. Not fun to lose, but the good news is that this only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it is going to be because it closed below my end of bar stop, and the end of bar stop is generally going to be much higher, much closer to your entry than the emergency stop. So on the uh, this particular trade, my end of bar stop was a close below the low of this first swing low. Right here, you can see a swing low is a low that has a low higher to the right or to the left and a higher low to the right. Makes this little pivot here. All right, so and a close below here would be my end of bar stop. Now, whenever I position size correctly based upon the signal. I placed my emergency stop 2 ATRs below. I know where my end of bar stop is going to be. Now the next thing I do is I take my entry, which was 28.85, and I add to it the value of the 1.5 ATR. So this is 1.5 average true range, and that at the moment it's different back here when I bought it, but it changes every day. I take my entry plus the 1.5 ATR plus 91 cents. That is going to be, and that is this line up here, the orange line above here. That is my trailing stop level. So it's just simply the entry price plus whatever the value of the 1.5 is that particular day. And this goes above your entry, 1.5 ATRs above entry. Now, if I get there, don't always get there obviously, but if I get there, now I go into what is called trailing stop mode. And trailing stop mode just means that now in the future, if I reach trailing stop level and then I have a close below previous bar's low, I will get out of half of the position. Okay, so the position sizing based upon the current volatility and your account value, that is a defensive move. Your emergency stop is a defensive move. Your end of bar stop is a defensive move. Your trailing stop level is a defensive move. Um, these are basically rules that if things go against you, that you will get out of some of your trade. But I also like to trade uh, uh, offensively as well as defensively. And the way I do that is I take partial profits into moves, strong moves that go my way. So let me show you the best way to do this. I always take, and I do this every day, I take the closing price of the last day's bar. Well, right now it's 29.16. And by the way, everybody, of all the trades that I have here today, I'm just doing a little extra on this first one here just to kind of give you an idea. I won't be this thorough on every particular trade going forward today. So I take the closing price, 29.16, and now I add the value of the 0.45 ATR. So the 0.45 ATR is 0.27, 27 cents. So I take the closing price, 29.16, plus 27 cents on Monday. My first profit target, because I have 3 profit targets every day, my first profit target for Monday is 29.43. So it'll be right about here. And then I take my first profit target, I add the value of the 0.45 to it again, plus 0.27. My second profit target is going to be 29.70. Then I'm going to take $29.70, the second profit target, add it one more time, and that will be my third profit target for Monday, $29.97. Now, if it goes down, I don't hit any of them. That's fine, right? But if it does start to move up, then I have standing limit orders every day based upon what I just showed you, taking the closing price, adding the 0.45 to it 3 times, and those are your 3 profit targets. And if they hit those profit targets, let's say it hits one, I'm going to take off 10% of the remaining shares that I have. So, with any great sports team, you need to play offense and defense. And in trading, in my opinion, you need to play offense and defense as well. You have rules that if it goes down, you're going to get out of some or all of your position. If it goes up, then I take partial profits into that. It's a fine line. You don't want to take everything, but you want to take a little. It reduces your position size. You lock in profits that the market then can't take away from you. If you have a huge reversal, then it mitigates that reversal. And basically, when it comes down to it, it just keeps you, it helps you stay on track so that you can follow your process better. Okay, so that's basically everything. Now let's go through the trade. Okay, so on this big bar here on the 9th, we took out this swing high. We now have a bullish fair value gap in the green. So it did come down. I got long here, 28.85. I positioned size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below this swing low. Place my 1.5 ATR trailing stop level above. And if it moves up significantly, or the value of 0.45 ATRs, then I take profits. Okay, so bought here, 28.85. Intraday on this one, moved up right. I mean, it bounced almost right where I bought it. Took some profit targets. Next day, nothing. Next day, big day up. So a couple things happened here. Not only did I get to trailing stop level, and now I'm in trailing stop mode, I also took off, I believe, 3 profit targets on that move. So reduced my position size, locked in those profits, all good. And then again, we did get to trailing stop mode. Next day, didn't do anything. No profit targets. Next day, inside par, didn't do anything. The next day here on the 19th, we closed below a previous bar's low after reaching trailing stop level. What do? I take off half of the position that I have. Now, am I glad I took off half? Yeah, I am, for sure, because that was basically the top. Then we went down, had a big reversal down here, and it just kept going down. I thought, well, I'm probably going to be out of this trade. I'm really glad I took some profits when I had them. I'm glad I removed half the position here. But look here. Here's my stop, a close below 28.88. We got very close to it, bounced, and then we came down. And look here, 2 days in a row, intraday, we went below my end of bar stop, but closed above, which kept me in the trade. So my analysis on the stop was correct. That seemed to be the place where there were no more sellers. So here on the 28th, barely stayed in the trade by a thread. Then we moved up here, took some profits. Here on the 7th, hit 3 profit targets again. Next day went down, and then here on the 9th had a huge move up, which, what did I do? I took 3 profit targets into this. So all in all, even though this has been a really volatile trade, the process and the rules that I've been using have made this quite a nice profitable trade. And then that was Wednesday, Thursday, Friday, we came down, but now we are back into this green box. So the remaining shares on this particular trade, not up a lot, up 1.10%, but again, I'm up a lot more on this trade because of the rules that I have of taking partial profits, the trailing stop rule, and I took profits into every big move up, which so far has made this a pretty good trade. But so anyway, this was a fair value gap. The remaining shares up 1.10%. Okay, SPY. This is a short trade. This so far is a losing trade. And let me bring your attention back here to the 19th of September. You see this red bar, this red box here. This is what is called a bearish abandoned baby. And abandoned babies and island reversals are very similar. Abandoned baby uses one bar, island reversals uses multiple bars, more than one bar. This one hasn't worked out so far, but these are some of my favorite strategies. And if you'd like to learn more about abandoned babies, island reversals, and I have had some really great trades this year using these. Again, they don't work out every time. In my opinion, or my experience, they tend to work about 70% of the time. And well, let's go through the trades, and we'll get into it a little bit more. So why did I mark this bar red? Well, the reason why is we gapped up, and then the very next day we gap down. If you have a gap up immediately followed by a gap down, more times than not, when you look out into the future, you're going to be lower. If you have a gap down and then you have immediately have a gap up, more times than not, you're going to be higher in the future. So this is the only strategy that I use where I don't take partial profits, and it's basically one thing's going to happen or another thing's going to happen. So I got short here 569.33 because of the bearish island, or because of the bearish abandoned baby. I'm going to position size the same way that I do, the same way that I showed you with the 1%. I am going to put my stop two ATRs above because this is a short, and I'm going to place my profit target 4 ATRs below, so that if I'm right, I'm going to make twice as much as if I lose. But again, in my experience, 70% of the time I'm going to make twice as much, and 30% I'm going to lose half as much. That's a recipe to make money in the long run. But this particular trade, not working out so far. Don't know. Still could. You never know. So I got short here, 569.33. I placed a 2 ATR stop above, a 4 ATR profit target below, and I just set it and forget it. One of two things is going to happen. I'm going to hit my 2 ATR stop, or I'm going to hit my 4 ATR profit target. This particular trade so far, like I said, is at a loss of 1.77%. If it does get up here to 583.60, which is my stop, then I'll just go ahead and take the stop. But again, with a casino, if they lose 2 or 3 rolls of the dice on craps, they don't go, well, this isn't working anymore, and shut it down, right? Well, this is the kind of scenario that I'm trying to paint for you. I've used this strategy for quite a long time now and really have done well with this strategy. And if this one stops me out, oh well, it's fine. That's just like a casino taking a loss on a hand of blackjack, or a roll of the roulette wheel, or a throw of the dice. It doesn't matter. I know in the long run this makes me money. So anyway, this one down on this short, 1.77%. Okay, Walgreens, the WBA. This is a strategy that I use called the deep dip buy. I've been using the deep dip buy for a long time. I teach it in my lessons. I've had some great trades. I have more of them today on the weekly that I'm going to show you. But deep dip buys use the 200-day moving average, the 250-day moving average, the 300-day moving average, and also the 30 RSI. Any of those, any of them together is fine. If you get 2 or more, like an under 30, over 30, along with the 200, 250, or 300 moving average, it's a great signal. But this particular one was an under 30, over 30. So that's the rule. From an RSI perspective, here's your RSI down here. On the day before I bought the trade, or entered the trade, September 25th, it closed under the 30 RSI. So I don't want to mess with it under the 30 RSI unless I have other moving averages below. And the day I entered it, the previous day closed under 30 RSI. The next day, the day I entered on the 26th, it closed above the 30 RSI. So that was my signal. I got long $8.51. Now, I always talk about confluences. An under 30 over 30 by itself is a legitimate signal, but that's basically it. I want to have something else that tells me to get into the trade. And the 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 something else that I'm talking about here is a double bottom with a bullish MACD divergence. You can see the red bars here, the green bars here. MACD is just a measure of momentum. So look back over here around the 5th of September. We make this low, and you see we have these deep red MACD bars. Okay, then we rally into some green. You can see the green here. And then here, when when we closed under 30 RSI, we're lower here than here, right? But look, no red bars whatsoever. This is showing you that even though this looked like a pretty substantial down move from a MACD perspective, there was no red MACD bars. You could even have red MACD bars, even they just have to be not as deep as over here. But this was even stronger because there's no red MACD bars at all. You know, I studied one-on-one with Dr. Alexander Elder, and he is the one that taught me this approach. And I remember thinking when I looked at this chart, I said, boy, if Dr. Elder saw this chart here, he would really like it because of this dramatic double bottom bullish divergence, MACD divergence here. So big picture, we have this divergence. All this means is that you're kind of running out when the MACD is not confirming that this low should have more red bars here, and it has no red bars here. This means MACD or momentum, selling momentum, is really starting to run out, and the implication is if the sellers are starting to deplete themselves, you're going to go up. But now, just because you have a double bottom bullish divergence doesn't mean you just rush into the trade. You still need the signal. Well, here was the signal. The signal that I had was the under 30 over 30. So that was a confluence. Big picture, we have this double bottom bullish divergence. The entry signal was the under 30 over 30. So I got long here, $8.51. I position sized correctly. I placed my emergency stop 2 ATRs below. On this strategy, if you have an under 30 over 30, then your exit is going to be if it untriggers or closes below 30 RSI. Okay, so then I placed my 1.5 ATR trailing stop level there. So I got long, 851. Next day, rocketed up. What did I do? I took some profit targets because it moved more than the value of 0.45 ATR. It actually moved double that. So I took 20% of the shares off, reduced my position size by 20%, and I got to trailing stop. Then here on the 1st of October, we had our first close below a previous bar's low. I removed half of the shares that I have. The remaining shares that I have, I took off half of them, locked in a gain of 2.3%. And then we have moved up ever since then, hit one profit target on Friday. So the remaining shares that I have here on WBA doing really well, up about 7.71%. So pretty nice trade. Double bottom, bullish divergence, missing right shoulder, and the trigger was an under 30 over 30. So remaining shares gain of 7.71%. And by the way, earnings are on Tuesday, and I don't hold through earnings. So I will be exiting this position on Monday, regardless of what it does. You know, holding through earnings is a fast way to make a lot of money quickly, but it's also a fast way to lose a lot of money. And as traders, our number one priority should be to conserve money, manage capital, and not put ourselves in positions of something bad happening. And earnings is a time when that could happen. All right. So WBA, remaining shares there. And by the way, you know, I know that I have I trade 7 different trading approaches, 7 different strategies. I have a lot of different rules. If you're new to the channel, you might think, boy, there's a lot of rules there. There are, and all the rules are here for a reason. You know, I've been trading for 29 years. Every single rule that I have, there's an absolute reason for it. It's not just there for no reason, all right? And I do teach private one-on-one lessons in the evening time via Skype. I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. I love to teach, and you know, the 7 different strategies that I teach in my course I think are invaluable. And I think the best way to learn anything is one-on-one with your instructor. So that's why I format the lessons these way. So it's a 15-hour course, 5 sessions. Each session's 3 hours, and if you take my course, you're going to learn a lot. I promise you. I've taught so many people, and it really has improved their trading. So if you're interested in doing the course with me, I'd love to teach you, share with you all my experience and all these strategies. And all you have to do is send me an email. The email is in the description of this YouTube video. So reach out to me, and I know you'll be glad that you did. Okay, so that is WBA, and I think that was the last. Yes, those are the open trades. So the open trades, the rest of what I'm going to show you on the daily are closed. So the 3 open trades that I have: Pfizer up 1.1%, SPY negative down 1.77%, and WBA up 7.71%. Okay, now let's talk about the closed trades that I took, but I am out of. Okay, so TLT, boy, TLT has really, really, really gone down. TLT are bonds, and I'm really quite bullish on bonds here with this major sell-off, but I'm just looking for a signal. So you notice the red boxes: bearish island reversal, down; bearish abandoned baby, down. So I think I marked a few more in here. Did I? Yeah, look here. Bullish island reversal. So you can see why I like to use those. They don't work all the time, but they work more than they don't. So I was last week during the podcast, I identified the 200-day moving average here, and I said, you know, if we get to the 200-day moving average, I am definitely going to take a shot at getting long bonds. And I did. I got long here 94.41 right when it got to the 200-day moving average. So I position size correctly, placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. My end of bar stop was simply a close below the 200-day moving average. Next day it went down, but it held the 200-day moving average. But the next day, on Thursday, it opened and closed below the 200. So what do? I have to get out of the trade, right? I have to get out of the trade. So it was a very small loss, which is fine. It was loss of 0.3%, but that's the key in trading: being patient, waiting for a level to get rejected, take the trade, position size correctly, and then make sure you have a good risk to reward. Well, my risk to reward was super good, right? I'm just here at the 200. I'm staying in this as long as it's over the 200. But if it closes below even a penny, I am simply out of the trade. And that's what I did. So you're going to have a lot of losses in trading, but the key is be very impatient with your losses and be very patient with your winners, and have a process that tells you what to do. So am I bummed out that I got right out of the trade after one day? No. Actually, that shows that I'm trading well. If you're in trades and out of trades quickly, it means you're following your process. You're not allowing losses to build up and build up and build up. Where you want to be patient and allow gains to build up and build up and build up is to be patient if it's above your stop. Well, it closed below. So did take a loss, a very small loss here on TLT at 0.3, but there are other levels, and when we get to the potential trades for next week, I've already marked these as well here. Okay, but this one down 0.3%. Boeing. Okay, Boeing, this is kind of a bummer trade, I gotta say. What I used here on this particular trade was this long-term trend line channel. I took the low back here on the 5th, drew it out into these lows here, And then the trigger for the trade was this particular trend line that comes down here. On the 23rd, not only did we bounce off the bottom of that extended channel, we also broke the trend line to the upside. So when you break a trend line to the upside and then you come back down to the trend line, that's where I like to buy, because not only did it break the trend line, came down to that trend line, but it also came down to this longer term channel. So I got long here 152.30, placed my emergency stop 2 ATRs below, placed my 1.5 trailing stop level above. Uh, for the moment, I had got the bottom, moved up, came down here on the 1st of October, went below that trend line, closed back above it, which kept me in the trade because that close below that trend line was my end of bar stop. And then just kind of moved around here. Then we moved up here. I did take a profit here. Next day, I did take a profit here, which I'm glad that I did because I locked in a little profits and I reduced my position size. But on Thursday, we closed below that trend line. I had to get out of the trade for a loss of 3.69%. But can you see, even if you take a trade, why it seems to be a good thing to do to take partial profits, so that if you do, you're in the money on a particular trade and you're reducing the position size so that if it does reverse back on you, you mitigate the loss. So this was a loss of 3.69%. And then Monday or Friday, it just went right back up, which, that's life. That's how it happens. But I am out of Boeing at the moment. Google. Okay, Google is a deep dip buy. And here we go. This was a really good trade. I got in Google back on the 9th of September. You see the orange line here? This is the 300-day moving average. So remember, with deep dip buys, the 200, the 250, and the 300 are all legitimate rejection levels. And this particular trade was a really great trade because during the day it went below the 300, closed above the 300. So I position sized correctly at 148.58. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. I placed my 1.5 trailing stop level 1.5 ATRs above. So I entered for the next couple days. It just kind of went sideways. Here on the 11th, it was below the 300 during the day, but I wait for the close of the day and then closed above. So that kept me in the trade. Then on the 13th, had a nice move up, took some partial profits, also got to trailing stop level, which means now in the future, if I have a close below previous bar's low, I will get out of half. The next day continued up, took more profits. Inside day, next day moved up, took more profits. Here on the 19th, had a big gap up. I took 2 profits. And then here on the 23rd, we had our first close below a previous bar's low after reaching trailing stop level. I took off half the remaining shares at a gain of 8.24%, half. Then we kind of moved sideways, didn't do much. We continued up, more profit targets here, more profit targets here, more profit targets here on the 1st of October. Now, at this point, when this trade starts to get extended, we did get into the 65 RSI level. And whenever I have a trade that I'm long and it gets to the 65 RSI level, now I have other exit rules that kick in. One option is it goes up to the 70 RSI, rejects the 70 RSI, then I, can do an exit there. Or if I get to the 65 RSI level and then close below the 5 EMA, this is this light blue line here, then that tells me to exit the entire trade. And that happened here on the 7th of October. And I did exit the remaining shares of Google for a gain of 8.8%. So really good trade so far. Deep dip buy, one of my favorite approaches. Like I said, a lot of different rules, but again, I teach the deep dip buy, and I teach all the rules in the one-on-one course that I teach. Oh, I always forget. Hey, if you're finding anything helpful here or anything of value, I really would appreciate it if you could hit the thumbs up button. It really does help out the channel, lets YouTube know there's some valuable content here, and helps keep the channel around. So if you're learning something, finding it valuable, if you could hit the thumbs up button before you leave right now or before you leave, I would really appreciate it. So Google completely out of the trade now for a gain of 8.8%. All right, next trade, VIX. All right, I did exit VIX on Wednesday, but let's first talk about why I took the trade. Okay, this is called, I took this trade, I've been in this for quite a while, all the way back to August 19th. Why? Okay, this is called a bullish order block. This is the green box here. Um, and because we had this huge move up, it kind of messes up the charts a little bit difficult to see. But this green box is basically the high and low of the bar on July 23rd. This was the lowest bar close before we had a change of structure, right? Here's a previous high. On this particular day, we changed structure to the upside. And so the high and low of this order block on the 23rd is the green box. So we went skyrocketing up on VIX, remember that? And then we came all the way back down. And I remember talking about this on the podcast, like over here. I said, if we get down to this green box, I'm going to buy. I don't know if it'll get there. Maybe it will, maybe it won't. But if it does, I will consider buying. And that's exactly what I did. So I did buy when it rejected the green box here at $44.70. Well, it turned out to be a really good thing to do. And we moved up here, we moved down, then we had this huge move up, which of course I took some profits, multiple profits on that particular day. And we also got to trailing stop level. Okay, so on that big bar up, I reduced my position size. I think I hit 3 profit targets, so I took off 30% there. And we got to trailing stop level. Then we had another big bar up here on the 6th where I took some more profits. Obviously, I'm in trailing stop mode because we got to that orange line. And then here on the 10th of September, we had our first close below a previous bar's low after reaching trailing stop level. I got up half the position for a gain of 12.69%. So that was a really, really nice gain. We moved down, we moved down. Then we had this huge move up on these big up bars. I took profits here on the 7th. Obviously, when we had this big surge up, I took more profits. At this point, we're at to the 65 RSI level. So now this 5 EMA comes into play. And if I get a close below the 5 EMA, what am I going to do? I'm going to exit the remaining part of my shares based upon my rules. And on Wednesday, I did get out of all the remaining shares on VIX for a gain of 17.1%. So this was an order block trade, really, really good one. Exited the remaining shares at 17.1%. Okay, let's go to the weekly bars. So, well, just recap on the closed out positions. TLT on the daily, TLT loss of 0.3%, Boeing loss of 3.69%, Google gain of 8.8%, and VIX gain of 17.1%. So not all my trades, not, experienced traders, not all their trades are going to be winners. So that's, I don't even think about that. It's not even possible. But the key is that you can see that on the positions that I've showed you so far, that the losing trades generally small, the winning trades some big ones, and that's the way that you make money in the long run over trading. All right, so let's talk about the weekly trades that I currently have at the moment. Okay, so in addition to trading the daily bars, daily charts, I also like to trade the weekly charts as well. And the weekly charts close on Friday. So on Friday, I make the decisions for a weekly trade. So in this particular chart, you can see that I have a red box at the top. That should probably give you a clue that I am looking for some type of short. So this is an order block over here on the 12th of July. You have the high and the low. The high was 232.81. The low was 222.99. So this is the highest up bar close before we have a change in market structure. This bar here created the change in market structure by taking out this swing low. So just like I was showing you on some of the previous longs, when you change market structure from a bearish to bullish, you probably want to buy the first dip. It's the exact opposite on a short. When you change market structure from bullish to bearish, you want to look to probably short a rally. So anywhere in this red box is the shortable area. I did short here at 228.80. One, because it's in the red shortable box, and two, it's halfway of this big down bar back here on the 19th. Whenever you get a big down bar like this, if you get back to about half of that, that's generally where you're going to find some resistance and maybe go down from there. So my stop, so I entered short 288.80. My stop, my emergency stop, of course, is 2 ATRs above. Always have that in there. My end of bar stop is a close above the high of the order block, which is 232.90. I place my 1.5 ATR trailing stop level below. And then, of course, if it moves down the value of 0.45, I will take some profits. So again, I got short here 288.80 on the 30th of August. Next week, it did move down enough for me to lock in some profits, take some partial profits off, reduce my position size. Next week didn't do much. The next week, we opened way down. What did I do? I took off more profits, right? I hit another profit target and again, reduced my position size. Did not quite get down to trailing stop level. Then we reversed strongly that week, and now we've just kind of been going sideways. So this particular trade, not doing a lot. It is in the it's in the profit. It's profitable about 1% is all at the moment, but better than a loss for sure. But actually up more on the trade because I took the partial profits when I had them. So that's Apple, gain of 1%. Disney is a deep dip buy on the weekly. I entered here 85.90. We went under 30, over 30, so that's a deep dip buy. Got long 85.90. 2 ATR stop below. My end of bar stop was a close below 82.95. My 1.5 ATR trailing stop level up here. Moved up the next week, took a little profits, then for a month didn't do much, and now we've then here on the 20th moved up nicely, hit some more profits, and got to trailing stop level. Next week moved up, took it some more profits again. Now I'm in trailing stop mode. So now if I have a close below a previous bar's low, I'm going to get out of half. You can see this week, during the week, we were below the previous bar's low, but we closed above, and the closing price is the important price. So currently on Disney, a gain of 8.61% on that deep dip buy. All right, last but not least, QLD, which is double leveraged short SPY, Qs, excuse me, QQQ. This is a bearish order block. Again, you have the red box here. The high and low of the 5th of July was 107.11, the low 98.68. Anywhere in this red box is the shortable area. Again, similar with Apple, I picked the short. I got long here. Oh, excuse me, I didn't put the bar there. I got short here, excuse me, on the 27th of September because on that week we did get to halfway of this big down bar here on the 19th and rejected it. Got short at $100.20. My particular stop on this trade is just a close above that high there of 103.12. This particular trade is down so far 2.38%. And again, my end of bar stop on this is simply a close above 103.12. You can see we're at 102.58, so has not come into play yet. So on the weeklies, the current open weekly trades, Apple is up 1%, Disney is up 8.61%, and QLD, the short, is down 2.38%. So those are all the trades that I made last week. Again, not all winners, but the main thing is if you have losing trades, keep them small. Be very impatient with your losing trades and stay in the winning trades and have a process to do that. It's important that you get yourself a process. All right, before we get on to potential trades for next week, let's talk a little bit about trading psychology. I love this chart. Not sure where it came from, but I wanted to share it with you. Again, trading is about following a process, but a process um, deals with many different things in trading, not just hitting the buy button and the sell button. And in the process that I just showed you with position sizing, I've kind of covered this, but in order to have a good trade, you have to think of many different things. First thing, position sizing. You heard me talk about that. Position sizing is a very important part of trading, right? It's something that you have to have. But in addition to position sizing, you have to have the discipline to follow your signals. Then you have to wait for the good signals, and then you have to have the correct price action. So it's a combination of having good signals, discipline, price action, process, and position sizing. And when these all meet up in the middle, this is where you become profitable. But it's not just good signals. Good signals, you need them, but you need more than that. You also need to position size correctly. You need to follow your price action, right? And you need to have the discipline to do that. So it's, these circles meeting here in the middle, that's it's like a table. A table's not going to stand up with one leg. You have to have multiple legs in order for that to sustain itself and to stand up. And in trading, it's the same thing. You have to have a good process. You have to have good position sizing. You have to have discipline to wait for good signals and then read the price action. So main thing is, everybody, get yourself a process where you get out of trades, losing trades quickly, you stay in winning trades, and you have a process that tells you what to do, and you know how to position size. These are all the things that are very, very important in trading. All right, let's turn to potential trades for next week. Now, again, they're not where they're supposed to be. The different charts that I'm showing you, they're not where I need them to be yet. If they get to where they need to be, then I'll consider taking the trade. If they don't get there, then I'll forget about them and I'll wait for something to get to where I need it to get before I'll take the trade. And by the way, here I have seven potential charts for next week. Now, again, theoretically, on Monday, all 7 of these could trigger. Does that mean I'm going to take all the trades? No, I always narrow and have a rule where I only take one trade per time frame per day. And here I have 7. All 7 of them could trigger, but I'm going to narrow doubtful all 7 of these are going to trigger, but if they did, I would still narrow it down to the number one best trade. And I allocate like a scoring system to each particular trade that gets to where I needed to get to. Which one, if one has multiple signals, I give it a point. If it has a better risk to reward ratio than another one, I give it a point. So I look at position sizing. I look at risk to reward. I look at the multiple confluences. How many signals does it have? How does it look on multiple time frames? That's another way that I narrow it down. And is it very strong or very weak compared to the rest of the market? These are the different ways that I give it a score, like a report card. And so all 7 of these could trigger, but if they all triggered on Monday, I would go through and go, well, this one has the highest score, right? And that the devil's in the details with trading, and this really helps you have more winning trades than not. And again, this is what I teach in my one-on-one course, how to differentiate and narrow down to the highest quality score trades. So here we go. First one starting out, ARK, ARKK. Well, you have a red box above here. This is showing that I am looking for some type of short trade. Back here on the 27th of September, we have the highest up bar close before we have a break in structure. So the structure to me is down in this particular trade. If you have a down structure, I want to short rallies, and I would consider shorting ARK if it got somewhere between 4807 and 4741 in the red area. One option is that it could get to the bottom of the order block reject. I may consider getting short there. It may have a V1 or a V2 in the middle of the order block. That would give it another higher quality score and may get short there, or it might just reject the top of the order block and come back down. But anyway, that's what I'm looking for on ARK, is some kind of short somewhere between 4807 and 4741. My stop, of course, 2 ATR emergency stop as always, but my end of bar stop would simply be a close above the high of 4807. FedEx, FDX. Okay, well, FedEx, this would be a deep dip buy. We have the large moving averages that were in this area here. The black line is the 200-day, the purple line is the 250, and the 300-day is the orange. Um, uh, I at this point right here, you have a lot of options. A close above the 200, that would certainly be legitimate. But me personally, I'm just going to have to wait and see. Yeah, close above the 200, I would potentially take it, but ideally, I'd like it to come down here into this green box where you have the 250-day and you have the 300-day moving average here. We have a V2 over here, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low, bar 3 closed above bar 1's close. So yeah, I'm ideally, I'd like to see this bounce off, reject the 250-day or the 300-day moving average. That's why I drew the green box here. But a nice strong close above the 200, I also might get long there as well. So just kind of a wait and see there. The Japanese yen. All right, well, we had the huge move up in the Japanese yen, and I highlighted, look, the island reversals in red. Look at that. We gapped up. We had a day sideways. We gapped down. That nailed the top, as they very often do. Look over here. I know this is a little off the subject, but over here, look at this. Bullish abandoned baby. Was it right? It sure was. Bearish abandoned baby. Was it right? It sure was. Well, here we have a bullish abandoned baby. This one was not right. But we have the 200-day moving average now down here. This looks pretty interesting to me. So a potential rejection of the black line, potential rejection of the 200-day moving average. I would consider getting long FXY, the Japanese yen, as long as it stays above the 200-day moving average. I'm bullish. I'll stay in it, use my process. My close, my stop would simply be a close below the 200-day moving average. So this is something that I'm kind of watching carefully. After this big move down, I would expect some kind of bounce at a major level like the 200-day moving average. Microsoft. Okay. Microsoft has had quite a big sell-off, hasn't it? Well, you see here we have the green box. This is what I'm looking for a buy. Why? This is an order block. And again, this is what I teach in my one-on-one lessons. But look, back here on the 6th of September, we had an order block. This is the lowest close bar before change in market structure, similar to VIX and some of the other longs that I showed you. We had a down bar close followed by a big move up, would change market structure to the upside. If you're in an upward market structure, you want to probably buy the first dip. Well, look at this. Back here on the 7th and 8th of October, it came right to the bullish order block or the green box, right? And that's exactly where it bounced. I didn't buy it here. What I'm really looking for, two options on Microsoft. One, a close above the 200, that would be legitimate. But what I'm really looking for, ideally, I'd like to see Microsoft come down here to the 250-day moving average, which is at 405. So it's about 11 points under where we're at right now. But why I would really like that trade, this would be a very high quality trade for me, but I don't know if it's going to get there. But if it does, I'll probably get on it, because not only are we in the bullish box, the bullish green box, the order block, but inside of that order block, you have the 250-day moving average, which by itself is a legitimate entry. So that's the confluence. If we come down to the 250-day moving average and reject it, most likely I will get long there, because one, it's 250 at the 250, and two, it's inside this bullish area anywhere. And that's why I drew the the blue box here as well. Everybody, sorry. I know I'm having a little tough time speaking today. I woke up with a really bad head cold today, and it's been a little difficult doing the podcast because of the head cold. So I'm doing my best, but please forgive me. But that's what I'm looking for there, is the 250-day, because it dovetails with the bullish order block there. So we'll wait and see. Also, a close above the 200 I would consider, but the 250-day inside that bullish order block is really what I would prefer. Bonds. All right. So I have signals both on bonds, both on the daily and the weekly. You'll see when we get to the weeklies. But I am expecting a bounce in bonds. We have had a significant move down. Look, I'm kind of looking for this 300-day moving average here, which is at about 93.27, about 50 cents below. Actually, two legitimate entries both on Thursday and Friday on bonds, because we rejected the 250-day moving average here. I didn't take the trade because the 200 was right above us as resistance. It would have been legit to take, but I did not. I got out of the loss on Thursday. I could have stayed in, but want to follow my rules. But what I'm really looking for on bonds is like a V1 or a V2, maybe another test of the 250-day moving average. Obviously, if we gap up and we create a bullish island reversal, I would buy that as well. But I don't know until Monday if that's going to trigger that or not. But right now, the market seems to be respecting the 250-day moving average. Again, the 300s here. So I think on the daily, the 250 or the 300-day moving average or rejection, that may mark a short-term bottom. And then I have this green box down here, but that's for the weekly as well. So I think we are getting pretty close to a short-term bottom in bonds, because we've gotten down to all these indicators. But who knows? I could be wrong. Tesla. All right, so Tesla, had a huge move up. I remember I had a great trade on Tesla. I bought it back here on the 28th with this nice rejection, this deep dip buy here at the 200-day moving average, and that turned out to be a great trade. I did get out of the trade when it lost the 5 EMA, like I discussed on some of the other trades, and good thing I did, because it has come back down. But right now, we're coming to some interesting levels. It did reject the 300-day moving average. I decided not to take that trade because we were up on Friday and we were down. So that's the relative strength that I'm talking about, using that into, how to select your trades. But major areas here in next week on Tesla would be 208.40, which would be the 250-day moving average, or even better, the 200-day moving average would set up for really good risk to reward ratio. And you can see last time, did it respect the 200? It certainly did. Does it mean it's going to do it this time? No. But if it did it in the past, it's a little bit more likely that it will continue to do it. So the 200 seems to be, it has respected the 200-day moving average, the black line here. So I consider it at the 250. The 250 dovetails with this little bottom here as well. So I'm looking at the 250 or the 200 for potential to get long Tesla. And then natural gas. So natural gas had a great trade on natural gas all the way back here, everybody. Let me show you just the blend in. We were talking about bullish abandoned babies. Well, I did get long with that abandoned baby there. Gap down, gap up, 2 ATR stop, 4 ATR profit. Had to ride it out a little bit, but I did get out near the top back here in the end of September. But we are coming to a bullish order block. This is the green box, bullish order block. What is that again? That's your lowest close before market structure change. So if we can come down on UNG somewhere between 1396 and 13, just call it 1350 to $14. This is the buyable area down here for me. I don't know if it's going to get there. It may get close and then just take off. Yeah, that's how it goes, right? But this is a good example of me looking at a chart and going, ooh, that's the area. That's the location. If it gets there, it's probably going to be good. You know, the risk is it doesn't get there and just takes off, but that's just how it goes. But that's what I'm looking for on UNG, basically $14 to $13.50. That would be the buyable area for me. So those are the daily trades. And then let's go to the weekly trades. Again, these are weekly trades, so these will happen on Friday. Okay, so Adobe, this was a legitimate entry on Friday on the weekly because we bounced at the black line. We bounced at the 200-day moving average, but I didn't take the trade. Why? Well, because the market was up and Adobe was down on the day. It was down $8.15, 1.62. So, am I going to regret not taking that? Maybe, but I just didn't like the price action of that day. The green box in here is a bullish fair value gap. And so a bullish fair value gap with the bounce at the 200, that's a pretty good setup, but I still didn't take it. What I really like here is the 250 week moving average because it's at the bottom of the fair value gap. Remember, the fair value gap is bar 1, 2, 3, the high of bar 1, the low of bar 3. This creates this green box here. But just like on Microsoft, being inside a bullish order block or being inside a bullish fair value gap and having a major moving average would make sense. So 471.43, that's still 23 points, 24 points below where we're at. But that's where I would be comfortable getting long Adobe, is if we come down, reject the 250-day moving average at 471.46 because it's inside this bullish fair value gap. So this is another good example of looking and going, ideally in my perfect world, where would I buy this? That's where I would buy this. And so I'll wait. If it gets there, I'll probably buy it. If it doesn't get there, I'll wait for something to get where I need it to get to. Okay, bonds. I talked about bonds on the daily, but also on the weekly. Right here, 92.44. So that's like $1.30 below where we're at. What's important about this on the weekly? Let's take a look here. Well, the reason that I'm picking this point out here is that we have back here in July, we had a V2. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 obviously closes above bar 1's close. When you have a V1 or a V2, your bar 2, halfway of the bar 2 is an important level. That's what level that I'll use for stops. And here, this 92.44 price is exactly halfway of this V2. there should be some inherent support there. So from a weekly perspective on TLT, if TLT comes down to that halfway, comes down to that 92.44, there's a good chance that will find support there. And if it does reject that, then my risk to reward is really, really good, because if it rejects that and then just closes below 92.44, that would be my stop. So it's an important level. Bonds have sold off dramatically. It's a very key, important level, significant technical level at that halfway. But boy, I'll tell you what, if bonds get to 92.44 and reject, there's a good chance that that's the potential bottom. But I could be wrong, right? So if it closes back below 92.44, I simply have to get out. So that's TLT, but I like TLT both on the daily and the weekly. And then last but not least is UUP. That's the dollar. The dollar's had a, we moved down strongly. Now we're moving up. We're moving up on the dollar. That's why we're moving down on bonds, right? But just like I'm getting bullish on bonds, I'm getting bearish on the dollar, because you see the red box up here. We have the high and the low of this order block back here on the 28th of June. We broke structure to the downside. Therefore, I want to short rallies. So somewhere between 29.20 and 28.98 in this area here. This is what I'm looking for. This red line here at 29.01 is halfway at this big down bar here on the 5th. So, I could take a couple different approaches here. Rejection of the bottom of that order block would be one. The rejection of the halfway would be another. But this is what I'm looking for on UUP, is basically some kind of rejection of 28.98 or rejection of 29.01 here. This is the area that the dollar should come down. But, more than likely it will, but I could be wrong. So that's why I have my stops, right? Because I'm not always right. I'm wrong a lot. But the key with trading is if you're wrong a lot, it's fine as long as you're wrong small. And then when you're right, having the potential to be right big. So anyway, sorry about the voice and the little fogginess I have today. Boy, I just woke up with this really bad head cold, and it was more difficult than I thought to get through this podcast today. So anyway, if you found something of value here, I really would appreciate if you could hit the thumbs up button. If you're interested in private one-on-one lessons, I'd love to teach you. I'll teach you everything I know. You'll learn a very valuable skill, and I think you'll be very glad that you did. My email's in the link of this YouTube video. I have a great online course at udemy.com where I teach you the deep dip buy approach. It's very affordable. It's somewhere between $30 and $50 on Udemy. The link's in the description. And that video course is great. It's 9.5 hours, and I teach you step by step everything. So if you have any comments or questions, put them in the comment section. I'll do my best to get to them and get right back with you. I hope you have a good rest of your day. I hope you have a nice weekend. Be good, be safe. Please try to go out and do something nice for somebody today. World would be a better place if we could all do something nice for one another each day. And if you could also try to go out and do something nice for an animal today, an act of kindness, I would really appreciate that. They appreciated it. They appreciate acts of kindness just like we do. So anyway, hopefully I'll be more together next weekend and done with this cold. But thanks for your patience, everyone, and have a good rest of your week, and a good rest of your weekend, and a good week next week. Thanks so much. Bye-bye.
U.S. government required disclosure. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.